it for future purposes. So yeah, back to what I was saying. So one of the major things about FOMC that most people don't talk about is it's not just about Powell talking. It's not just about Powell coming and hitting the mic and saying good afternoon and the whole market goes into a chaos. The actual thing here is, why is the market going into a chaos is as a result of two things. There is uncertainty as to what he's going to say, and then there is market psychology as to why Powell is talking. Now, before Powell comes on that, should I call it, there's a podium, not a pulpit. Before he walks up to that podium and says good afternoon, there have been series of market analytics and analysis that has happened prior to him coming up to speak. Powell, on the other hand, and the Federal Reserve would have made comments from previous week based off statistics that have been released from other news events, likes of your CPI, jobless claims, NFP, unemployment claims, ISM manufacturing index, PMI, PPI. All of this statistics at the end of the day is what is gathered by the Bureau of Statistics and is given to the Federal Reserve, which is the FOMC committee. They now sit on this statistics and then look at it and say, okay, at the end of the day, what exactly is happening in our economy? Are we seeing more jobs? Are we seeing lesser jobs? Are we seeing increased number of pays? Are people getting paid properly? Are people not getting paid properly? Are companies falling short of production? Are people buying what is produced? Or are people not buying what is produced? All of these statistics at the end of the day is being sat upon by the FOMC, and then this is what happens. They then look at the statistics and say, okay, you know what? What are the progressive statistics to show that an economy is moving well? So I'll give you a hint. Here are a few statistics that shows progression in an economy, and if an economy is growing or if an economy is regressing. One is employment. And when we're done, I'm going to relate this back to Nigeria as a case study so you can further be more in tune and knowledge about how this country is messed up to an extent. In fact, not to an extent, to a very large degree, this country is messed up. So employment is one of the things that shows you growth in an economy. It shows if an economy is progressing or regressing. Another thing that shows you if an economy is growing or not is production. Another thing that then shows you if an economy is growing or not is spending. So these three things are very key. Now, the next thing after employment, another thing you can use to tell if an economy is progressing is its inflation rate. Now, not just its inflation rate, but also its core inflation. Okay, core inflation, which basically is every retail services. So coming from foods to the most minute things that you can buy is all going to come from there. Now, you can see that this four major things is one of the ways you can tell if an economy is progressing or regressing. Now let's bring it back to our country, Nigeria, for instance. If you're not in Nigeria, welcome. You're still in Africa. We're all almost in the same boats. Okay. So now this is what you're going to look at. How is the employment rate in your country like? Nigeria has, I think, 83 or is it 85% poverty, meaning that the whole country is soaked in unemployment. You can see it in your everyday life around you. How many people out of every 10 people you know, how many people are employed? 1. So it means that in every 1 million people that you find, only 1,000 people are employed. So statistically speaking, your country is regressing. The next thing is spending. How well and what is the average cost for Nigerian spending every day? Out of every 1 million people, only 1,000 people can confidently spend over $100 a day. Out of every 1 million people in a country of 290 million people, is it 190 million, 190 million, 290 million? I can't remember. But with that statistics, you can see that out of every 100%, just 1% can afford to spend over $1 a day, over $100 a day, which means that spending is low. Another thing you can look at is production or manufacturing. Are we manufacturing anything? No. Are there companies that are constantly manufacturing? Even if they are manufacturing, at what cost are they manufacturing? Are they manufacturing at a cheaper rate or are they manufacturing at a more expensive rate? If they are manufacturing at a more expensive rate, it simply means that what locally or the materials they're using for production is not situated in where they are manufacturing these goods. So making it more expensive to produce, and meaning that they are constantly having to import things that they use for production. So at the end of the day, what are we seeing? Higher cost of production, meaning that the cost of goods are going to be more expensive. Now, we just said spending is low. So if spending is low and the average man cannot afford certain things, and that means what? That even the companies that are producing and manufacturing these goods cannot sell in huge quantity. Why? Because there's not enough money in circulation for people to spend. So it means that what? The country is what is regressing. The next one is inflation. The most important inflation to any country first is not even the monetary inflation, but first the core inflation. Because core inflation is the prices, is the change in prices of goods and services that the most common man should be able to afford. Now, if the common man cannot afford the core things, like the cheapest things, let's bring it back to this country. The common man in this country right now can barely afford to drink Gary that used to be 20 naira for a cup of Gary. A cup of Gary today is 250 naira for a cup of Gary. So meaning that if you have not done anything progressively in your life outside of the amenities that the government gives to you in the past 10 years, you most likely today shouldn't be alive. You should be dead from hunger. The current food inflation rate in this country is, as at the ending of 2024, hit 40.98 in inflation numbers. And here we have the US struggling to keep inflation under 2% or at 2%. And if they can keep inflation at 2%, then we most likely can see what J. Powell starting to want to cut rates because he wants to keep inflation very low so that his interest rate can come lower. One way we can also go ahead to see this inflation rate is the first look at so let's use Forex Factory. Okay. So let's use Forex Factory, and so that you see the different interest rates and inflation numbers of countries like US and co. Of course, we definitely would not want to compare, a third world country to a first world country. But at the end of the day, one of the most important things that we want to see is that at least it's not so bad. Okay, so you can see here, the GBP is at 4.5%. You can see the USD at 4.5%, AUD at 4.10%. Now, mind you, this is USD keeping its interest rate at 4.50% because its inflation numbers is ranging between 2.6 all the way to 3.5. It was able to, the Federal Reserve of the US was able to bring down inflation numbers from as high as 7 from ending 2023 throughout 2024 back all the way to about 3%, which was a very good thing to see from the Fed, holding the country floating above recession. They were this close to a recession. Now, why are all this information important? When you're trading currencies, when you come to Forex Factory, the one thing they would always tell you is, actual is greater than forecast is good for currency. Actual less than forecast is bad for currency and all of those things. But one thing you need to understand is there's a differential between the currency and the economy. Now, the currency cannot necessarily survive without the economy, but the economy is a canopy to the currency. So in as much as when you see a news is released, boom, and the next you see is, okay, numbers are higher than this, you need to understand that there's a differential you need to look at. If a higher number is good for currency, is it overall good for the economy? Because if it's bad for the economy, then in other words, the currency is going to be shitty. So what most times we see is aggressive traders running into the market because of the macro release, and that's why sometimes you get trapped. Now, let's take, for instance, we can see gold pumping at the moment. Now, why is gold pumping? So let's look at the news and let's see what was the release like. Okay, today is 19th. Funds rate was left at 4.5%. Now, if the fund, like I said, if you watched my video on YouTube, my YouTube reel, I said I expect Powell rather to keep interest rates at the same pace, because We saw CPI drop from 3% back to 2.6%. And his major goal, from what he has been saying, is what he wants to see inflation numbers and keep them under 2.5% to 2%. That's where he wants to leave them. And if he can stay under there for the whole of first quarter, then he might cut rates in the second quarter. But if for any reason inflation numbers should keep going up, then he might be left with no choice than to hike rates. Now, this is what hiking rates and cutting rates mean. When a country is suffering from inflation, it simply means that they need to tighten. Do you understand? They need to tighten their economy, so they might go hawkish. That's one. Secondly, is they need to tighten the economy to a point where the country is doing good, but at the same time, they are not overspending and they are not underspending. So what they would usually do in this kind of situation is not just to use their own money to run the economy, but then want investors to put their money into the economy so that they can use it as a cushion or a balance to do what one of the most important things to do during high inflation is to make sure that your labor force is thriving, meaning that you want to make sure that there's enough employment for people so that they can, in other words, be able to earn and be able to afford the basic things, even though the prices are higher. So like we said, if spending is low, there's no employment and cost of goods are expensive. That's where you now have a very rapid inflation to the upside, because now people cannot afford anything. But if you pull in investors, for instance, and you're borrowing these investors, you're allowing these investors come and probably put their money in, use their money to create more jobs, or they come and open up manufacturing businesses or whatever in your country, and they're opening up more jobs. You're telling people, okay, this is how they should run things, they should create more jobs and everything. The more jobs are created, if the labor force is growing, for instance, it means that people are getting paid properly. If people are getting paid properly, it means they can then afford the goods that are more expensive. But if you can now see that your economy is thriving, labor force is on the high. Okay, give me a minute, guys. Okay, so if the labor force is thriving, okay, and is growing faster and better, and then there are more jobs, people are earning more, inflation numbers wouldn't really be a case of concern. Why? Because your spending and your labor force can catch up and meet up to the cost of goods and services. So that means you're keeping your economy at float. But if not, then you're going to be suffering. So the major things that the Federal Reserve looks at, first of all, is the inflation numbers, fine and good. We understand that. Now, the next thing they also want to look at is, what's the labor force looking like? What's the labor force looking like? Are there people earning enough money to spend? And if that's working for them, then they are good to go. So with all this being said, let's do a little bit of watching and see what Powell, okay, is talking about, and just so you can listen. Okay, it's not just always about the numbers. Learn to watch the news as well and learn to listen. Okay, so let's watch the live stream. You can watch the live stream with me. Okay, so everything he says, I'll do my best as much as possible to break it down for you guys. If you can hear the audio coming from the screen, you just let me know. I hope Telegram will be able to pick it, so be able to hear it. Okay, it's still loading. Okay, let's go to YouTube and see. What's the issue? Can I confirm that you guys can hear me, please? Can you confirm that you can hear me? Seems like my network is going cuckoo a bit. Can you guys hear me? Okay. So I'm trying to, I don't know what's wrong. I think it's network or my, okay. Either network or my browser is a bit stuffed up because I hardly turn off my system. I heard it's bad, but I'll do my best to learn. So I think it's constantly making my distance slow. So you can always come back to my YouTube. Okay, so I have a lot of videos on fundamentals that you can watch in your own time. We have episodes with Tony Sniper and ICT Queen herself. Okay, you can always come back. I have a lot of videos on fundamentals here, but we want to watch the Powell talk for now. Okay, so I want to see Powell speak, not analysis. Paul is supposed to speak by what time? 7:30. Okay, he's supposed to speak by 7:30. So let's if you can hear the audio from my screen, please let me know. I don't know if it's going to play.
And the Fed keeps talking about their target being below 2. We can't get core inflation below 3, let alone get to their target of 2%. And if they start cutting rates again, they run a very big risk of a bad reaction.
Jim, how does an explosion of fiscal spending in places like Germany and China complicate the story when suddenly there's a lot more competition?
Guys, can you hear
around the world?
Can you hear the audio from my screen? If you can't, I'm just going to copy this link and send it to you. So probably if you're connected from your laptop, you can just tune in maybe on your phone. Okay? Some things might sound like jargons to you, but just pay
to fund people's deficit.
Some things might sound like
look at is, we had with CARES Act.
Okay, I think the problem is I'm streaming both ways at the same time. So
inflation in Europe, and that's going to reverberate through. Remember, when we had our uptick in inflation, so did they. I suspect they have an uptick in inflation. It will come back to us, not $1 for dollar, but we'll see an upward push of inflation. And I also think that that's also going to attract capital to Europe. They've got, they got down to like a 10 PE on a lot of markets when we were above 20. So they're a cheap market, and now they're stimulating, and they're willing, and at least equity investors are willing to tolerate more inflation. So bond investors won't. So,
my own robot blocked me from sending the link. Okay, so I just sent the link, so you can
see higher, you'll see those higher rates in Europe continue, and maybe higher.
So you can stream too as well. Okay, so now let's look at the charts. Okay, which is like one of the most important parts I know a lot of people are waiting for. So what we're going to do is look at the DXY sweet spike. We're still in the trade. Okay, so let's look at the DXY. So correlatively, something is happening here. Most times when you see stocks pumping up, the dollar usually is supposed to be on a weaker side. Okay, but we're going to be seeing something a little bit more different this time around, because the dollar and stocks lost correlation for a while. So what we want to see happening at this point in time is we want to see the market rearrange itself. Okay, after the end of first quarter, of course, by the end of this month, April is the start of the second quarter. So I'm expecting to see the market rearrange itself. Okay, so now let's look at the XY. I had this analysis on the XY. If you're not in my channel or you've been in my channel, you can go to the YouTube and watch the last video that was posted. I analyzed how everything was supposed to play out, and we did state that before the FOMC, I'll be expecting to see the dollar start to end its rebound, because there's going to be expectations of him cutting rates, meaning the dollar should be weak. But I know he's not going to cut rates because inflation numbers were good. Unemployment was lesser than usual. Jobless claims came out and people were able to see more jobs than usual. The people didn't file for so much unemployment claims. Okay. Now, if you look right above you, technically, you would see these huge sellers all the way here. And then we started to see markets slow down. Okay, now this is the law of the range theory. Okay, when you see market come from a huge momentum push like this, and all of a sudden market starts to play in a range, and within that range you're noticing something. Now this is the trick to it. Within that range, you want to notice a gradual shift in momentum. So what did you see here? More buy candles than sell candles. More buy candles than sell candles. Now I'm seeing what again? More buy candles than sell candles. So now what I want to start to see is massive buy candles, not just the smaller candles any longer, so that we can completely break out of this range, and then we can go higher. And then if prices continues to push above this high here, then it would indirectly mean that we've done what? We've gone bullish on a higher time frame. And then that would then bring us to a completion of the dollar rebound. Okay, now this is the rebound of the dollar from last year, from September last year. We saw the dollar push aggressively all the way to 110 on the DXY. Okay, but now, what was the major cause and fuel for this push to the upside? It was as a result of the Federal Reserve and the government playing their parts. We had a lot of fiscal policies and monetary policies side by side last year to control inflation and recession in the US. I told you they brought down their inflation numbers from about 7% all the way down to 3%. And it was just a very tremendous effort from both of them. And the moment they started to do that, they were hiking interest rates. It was that interest rate hikes that was constantly pushing the dollar to the upside. Because why? Investors want the dollar to be, to show opportunities for better yields. Okay, and it's that yield differential that aggressive investors are always looking for. But nonetheless, this is a cause of interest rate hikes. Okay, this is as a result of interest rate cuts. And then we saw the stagnation of the interest rate around start of this year, around January. We saw them leave the interest rate at where it was supposed to be. Now, would there be further cuts, and how would the cuts affect? Now, this is the tricky part to it. A lot of people think that them cutting the rates is just going to tank the dollar. Well, it's not necessarily going to tank the dollar, because if the overall well-being of the economy is good and they cut rates, we might see a minor tank on the dollar, but not necessarily going to just reverse the whole prices of the dollar till the end of it. Now, there's a median for the dollar. The median for the dollar is usually anywhere between 97 to 102. That's the median for the dollar. That is the median for a healthy DXY. Now, don't forget that the DXY is a basket. It's an index basket of how every other currencies, are healthy alongside the dollar, or how they are reacting to the dollar as well. So now, if we start to see a more healthy economy, then we're going to start to see the dollar play a slow and steady growth style, like what you're seeing here. Okay, so we're going to play a slow and steady growth style. You're not just to get all these rapid big candles to the upside or all of no. It's not going to work that way. You're going to see slow and steady growth. That's how you know a healthy economy. If you see markets just pushing one direction and then the candles are like very, very, very heavy candles, it means something is wrong. Or if they are coming down with heavy candles, it means something is wrong on the DXY. It means overall, either all the countries are suffering inflation or deflation or something. But what you want to see from a healthy economy is that the market is trending properly. So you don't want to see too much aggression. You don't want to see too much regression. You just want to have a stable this thing. So what I am speculating, because at the end of the day, we are all speculators of prices, is that we want to see market start to roll back up gradually. Okay, we want to see the economy strengthen gradually and play within the range. Okay, and continue to enjoy itself like that. We don't want to go too high above here, and we don't want to go too low below here. If we're going to close below here, we probably might be seeing below here if something happens, and maybe towards the third quarter, most especially, then we might see below here. That is when Powell starts to cut rates. Now, he's not going to cut rates aggressively. Like he said, when you cut rates aggressively, you push investors into a certain level of uncertainty and fear. So you start to make them, doubt your economy. At the same time, you don't want to hike interest rate too fast. So it's all about an equilibrium in the financial markets. They don't just do things reactively. They do them in steps, in process, and in bits. So when you see Powell cutting rates from second quarter, you see him cut rates by 0.25 base points. In order for him to cut rates by 0.50 base points, he's going to create a spiral in the market, and he doesn't want to do that. I've sent you guys a link. By the time this call ends, I want each and everybody to take out their time. It might sound like jargon to you, but with the few things I've explained, you should be able to understand what he's going to be talking about, and how he's talking about them, and why he's saying those things he's saying. And just pick a few things. A few things that I want you to pick from there is, when is he going to cut rates? Does he think he's going to cut rates? Secondly is, how is the labor market appreciating? If the labor market is appreciating, just listen to all those things. Just take your time. If you're really interested in understanding fundamentals, take out your time and listen to him properly. And you see that at the end of the day, it's not just about currency. It's always about what is the economy going to look like at the end of the day. Okay, so that's what I'm looking at. He's going to cut rates gradually, but for now, he's holding rates. He's holding rates at 4.5%. So my major speculation is we're going to see the dollar rebound end. Okay, we're going to see the dollar rebound end. At this point, we're going to go higher, and then maybe by, let's say, maybe middle of second quarter, middle of the year, he might cut rates a bit, continue again, keep rates normal, trend to continue. I'll drop a link to my YouTube video, and then it was just very short, and I explained what I'm saying now in just 1 minute, and I feel like that would answer your questions. So if you have any questions relating to fundamentals at any point in time, you're already on the channel, just leave a question in the chat section, and I'll do my best as well to answer it. I just wanted to let you guys know that don't be quick to trade the news. You get? Don't be quick to jump into Forex Factory. Oh, actual is greater than currency, I will buy. You're wasting your time. It's just one way hedge funds used to use us and cash out. You get? They wait for us to pump into the market, and then they go the opposite direction, because they teach you to trade FOMC and then use you as liquidity. Okay, guys. With that being said, it was a nice one having you guys on the call, and I hope you were able to, enjoy the call and learn a thing or two. I might have sounded a bit fast at some point. Bear with me. The video or the recording of this call is going to be up on my YouTube, and you can go back to digest it and watch it all over again if you want to. But if you did enjoy the call and you were able to learn something, just leave something in the chat section on the Telegram. And thank you, guys. I'll see you guys next week when we're going to be trading a better news. What do we have next week? I don't think we have CPI next week. There's no news next week. Probably upper week. Yeah, so probably upper week we will trade probably retail sales or unemployment claims, one of them, and we'll see how we can attack the dollar. But for now, be careful, guys. Stay bullish on the dollar. Trust me. Just give it time. Give it time for you to get that bullish confirmation. Okay, the bullish confirmation we're waiting for right now is for prices to actually take out this level. Okay, one price to take out this level, and stay bullish on the dollar, guys. Stay bullish. Okay, take my small advice, the one that I'm giving to you. and stay bullish on the dollar. We're finally going to start to see Euro USD sells. It's going to happen. It's going to happen. When it happens, come back to my DM. Just come back when it happens, okay? Remember, we bought NFP and we sold CPI. Okay, I'm sure you all remember. We bought NFP, sold CPI. I called this sells yesterday. It went back to our entry points and then started selling again. I didn't call it because I was busy today. I had to take a quick trip. So, but yeah, I will call Euro USD again. Let me just call it on this call right now. So if you're on Euro USD, you should be looking for sales from this level. Okay, so just wait for prices to come here and look for more sales. And just in case you can't spot it, we are in a double top formation. Okay. The best time to swing this trade is when we actually get a break below this level. Then we'll find another entry at this point here. And then we want to swing this trade all the way back to 106. Okay. So that's it, guys. Analysis shouldn't be too complex, too hard. Just play your role with fundamentals and you'll be good. So I'll see you guys next time, same place, on a different call. Until then, tell me how the session was and if you're able to learn something in the chat section. Cheers, guys. It's Ryan for a reason.